It's official. The United States has crossed the $36.99 trillion mark in national debt, and the Treasury just announced the X-date is weeks away. That's the day when the government runs out of cash to meet its obligations. And with Congress gridlocked and markets on edge, we are heading straight for a full-blown debt ceiling crisis. But this one's different, because for the first time in history, the cost of simply servicing the debt is threatening to break the entire system. Let's unpack what's really happening and why this moment could reshape global finance for years. As of June 18, 2025, the U.S. national debt stands at $36.99 trillion. That's nearly $2.4 trillion higher than it was just 9 months ago. Much of that spike is driven by soaring interest costs, now approaching $1.2 trillion annually. In fact, interest on the debt has officially surpassed the entire defense budget for the first time in modern history. And here's where it gets worse. According to the latest Congressional Budget Office report, the U.S. government is projected to run a $1.7 trillion deficit this fiscal year, despite record tax receipts. Why? Because nearly 40 cents of every dollar collected is now going straight to debt service, Medicare, and Social Security. There's no more room to maneuver, and the Treasury knows it. Last week, Treasury Secretary Scott Bessent warned that the government will exhaust its extraordinary measures by mid-July. That's the X-date, the moment when incoming revenue falls short and bills stop getting paid. If Congress doesn't raise the ceiling by then, the U.S. would face technical default on select obligations, potentially delaying Social Security checks, federal salaries, or Treasury bill redemptions. The last time we got this close, back in 2023, Fitch and Moody's issued stern warnings. This time, Moody's has already placed the U.S. on negative outlook, citing structural fiscal erosion and political dysfunction. And Wall Street is reacting. Yields on short-term Treasury bills maturing in late July just spiked past 6.1%, well above the Fed's upper bound target of 5.5%. That's the market pricing and default risk, however small. It's not panic, but it's real tension. And here's where it gets dangerous. This time, the Treasury isn't just facing a political standoff. It's dealing with an interest rate regime that magnifies every delay. For every week that Congress waits, borrowing costs rise. Every auction gets riskier, and every bondholder starts looking for the exit. That's how confidence unravels. And here's your open loop. What happens if the U.S. actually breaches the ceiling, even for just a few days? The answer isn't default in the traditional sense. The U.S. will still owe its debts, but the damage would hit in 3 places: trust, credit rating, and liquidity. First, trust. Investors across the globe, from sovereign wealth funds to corporate treasurers, view treasuries as the safest asset in the world. If the U.S. misses a payment, even temporarily, that trust is permanently weakened. Second, credit rating. A downgrade from Moody's would push treasuries off certain institutional balance sheets. Pension funds, insurance companies, and foreign central banks could be forced to reduce exposure, triggering forced selling. Third, liquidity. Even a small disruption in Treasury settlements could jam up the entire repo market, which underpins short-term lending across the financial system. That's the real risk. Not a default, a freeze. And that freeze could ripple into everything from mortgage rates to credit lines to corporate debt issuance, just as the economy slows under high rates and fading stimulus. Now let's look at the bigger picture. The debt ceiling debate is no longer about partisan politics. It's about math. With rates near 5.5%, every new trillion in debt adds over $50 billion in annual interest expense. And with deficits locked in above $1.5 trillion for the next decade, the debt will keep growing, no matter who's in office. That's why some analysts are warning that the U.S. is entering a compound debt spiral. What does that mean? It means that interest payments are growing faster than the economy itself. And that creates a vicious loop where more debt leads to higher rates, which leads to more debt until the system has to reset. One data point to watch: debt to GDP just hit 124%. That's higher than post-World War II levels. And the last time it was this high, the Fed was actively capping long-term yields through bond purchases. Today, the Fed is trying to exit that game, but it may be forced back in. If markets seize, if yields spike, or if liquidity dries up, the Fed may have no choice but to intervene. That could mean emergency QE, yield curve control, or even direct purchases of T-bills to prevent systemic collapse. And here's the reset. This isn't just about avoiding a technical default. It's about whether the U.S. can still function as the world's financial anchor. Because if treasuries lose their premium status, everything else shifts. The dollar weakens, global capital flows adjust, BRICS nations accelerate alternative payment systems, and the trust that holds the financial order together starts to fray. That's the risk we're walking into. And here's your stat hook. As of today, over 31% of U.S. debt matures within 12 months. That means over $11 trillion has to be refinanced in the next year in an environment of elevated rates, rising risk premiums, and growing fiscal uncertainty. If even a fraction of that rolls over at higher yields, the interest cost alone could breach $1.4 trillion by next summer. And here's the emotional spike. This is no longer a political talking point. It's a financial time bomb. And the fuse is lit. What comes next isn't just about deals in Congress. It's about whether the entire system can keep pretending that $36.99 trillion is sustainable, or whether the reckoning finally arrives. Watch the X-date. Watch Treasury auctions. And above all, watch the yield curve. Because when confidence breaks in the bond market, it doesn't come back. Subscribe to Wealth Signal for real-time breakdowns on the threats, trends, and signals that actually move markets before they explode onto the headlines. But there's one element no one in Washington wants to talk about: the long-term confidence shock. For decades, the United States has operated with the implicit benefit of exorbitant privilege, the ability to borrow at lower rates than any other nation because of its unique role as the global reserve anchor. That privilege is now under review. Major holders of U.S. debt, including Japan, China, and Saudi Arabia, have all reduced their treasury exposure in the past 18 months. Meanwhile, the BRICS alliance is ramping up bilateral trade agreements in local currencies, bypassing the dollar entirely. This isn't theoretical anymore. It's happening. In May, the Shanghai Cooperation Organization expanded its sovereign liquidity pool using yuan-denominated swaps. And Brazil just completed a major commodity deal with India without touching U.S. dollars. That's a warning, because if the world no longer needs treasuries to settle trade, then the demand floor under U.S. debt begins to erode. And if that erosion collides with rising issuance, strained auctions, and a politically weaponized debt ceiling, you get something markets have never priced in: a credibility crisis. One former IMF official recently warned that the U.S. is now walking the same road as late-stage empires, where debt issuance becomes a survival tactic rather than a growth engine. And when debt becomes survival, markets respond with flight. Flight to safety, flight to commodities, flight to real assets. The Treasury curve is already inverting again. Credit default swaps are ticking up, and hedge funds are loading up on short-duration debt and volatility hedges. They're not predicting default. They're preparing for disruption, and that's exactly where we are right now. If you want to stay ahead of what's really happening in global finance, subscribe now. We're just getting started.